Good afternoon, everyone, and welcome to another one of Avant-Garde's free educational webinars. Thank you all for joining us this afternoon. We are thrilled to welcome guest presenter Vlad Karpel and Keith Harwood, who's joined him today as well. They're going to be covering using probability to successfully select strike prices. This is going to be a great webinar this afternoon. We are thrilled to have so many of you live in the Zoom room with us. And Vlad, are you with us?
Yes, I am.
Wonderful.
Thank you for having me.
I can hear you and I can see you. Oh, it's my pleasure. Thank you for taking the time to put together the presentation and to come talk to everyone here. We do appreciate it. So whenever you are ready, you can go ahead and take control of the screen and pull up your presentation. And while you're doing that, I will remind everyone in the Zoom room, if you have questions during Vlad's presentation, please type those questions into the webinar chat or the Q&A. And I can feed those over to Vlad and Keith to address at the end of the presentation. All right, I can see your title slide, Vlad, so feel free to begin.
Perfect. All right, well, thank you again, Natalie and AGT for having us. Keith and I are super excited. We've worked a lot together on building different models and different programs to find opportunities in the market, and we do spend a lot of time talking about selecting option strike price, probably the most difficult task when you are dealing with options. And that's the goal for today, is to kind of make it a more straightforward process. I don't think it's ever an easy process, but it could you could create mechanics behind your process and be more process oriented and follow certain pattern of decisions. And that's the goal to go over today. We have a lot of people today. I'm super excited, probably one of the records. So this is great. My background is in technology. So I have a master's degree in computer science, specializing in artificial intelligence. Actually, my thesis was written on AI 25 years ago. So we've been working on AI for a very long time. Since I got my master's degree in computer science, I started working fintech space here in Chicago, UBS Princeton. I worked at Options Express, Groupon, Pick Six, and many other hedge funds and broker dealers here in Chicago. So that's been my passion. And started Tradespoon and Yellow Tunnel back in 2012. So it's been glorious 14 years. To use the knowledge that I've acquired, the team, financial engineers, to build signals and to also trade them in a live trading room. About 2 years ago, Keith Harwood joined from Options Hotline. He brings a lot of experience in, from the market making perspective, deep knowledge in options and futures. And without further ado, I will give Keith maybe can give a little bit more detailed background.
Absolutely. Thank you again, Vlad. Yeah, no, I think going back a little bit further for me now, even as I think about it, like I was a math major in college, so I'm all about these probabilities, these analytics, numbers games. So yeah, as Vlad mentioned, I was a market maker. I started my career in the pits of the CBOE back in 2005. Been trading options ever since. So I guess that's 21 years now. Time flies. I also worked for a hedge fund at CTA, very technical focused, and a lot of that is driven by trying to understand more about the statistical distributions and where a stock can go or where an asset can go. And that's ultimately, I think, one of the big keys for that option strike selection is understanding how likely it is that an asset's going to reach the target price and how best do you leverage the move to that target price. So I'm really excited to talk through a lot of that with you guys today. And as Vlad mentioned, I mean, a lot of the work that we've been doing together, taking the options analytics, combining it with AI, and thinking about the way that these stocks can and maybe are predicted to move, allow for some really good, interesting opportunities as long as you do the work on understanding the odds of success and how to best leverage the capital that you've got at your disposal. So,
Thank you. Again, we went over the disclosures. I'm not going to spend too much time. I'm going to go to specific trade ideas. If you haven't visited optionsclearing.com to understand risk and suitability trade-in options, I encourage you to do that. And you can always pause the screen for the remaining of the disclosures. Let's just do a quick review of options trading. How many of you actually do options trading? We have a lot of people on the broadcast, so maybe just type in, I trade options or I don't trade options, that would help us steer. But the good news is that even if you don't trade options, this is a very good exercise to help you understand, even if you don't trade options, what are the main support and resistance levels using options data, in addition to your traditional technical analysis. We went over chart patterns, moving averages, oscillators, but using strictly options data, you can also create another data point which you can use to determine how far can your stock go by a certain time frame, right? Very important question, whether you trade stock or you don't trade stocks. And all right, people are answering. I like it. I trade options every day. I trade options. Never traded options. All right, perfect. Bill, we're going to talk about why this is important, even if you don't trade options. So what is the options? Just quick review. It's a derivative, right, of underlying asset, right? And you can have options on futures, on currencies, commodities, interest rates. So definitely, originally was designed to give you a hedge, right? If you have a stock and you have your portfolio and there's uncertainty about the outcome of the war in the Middle East, how long it's going to be, what will be the oil prices, and you want to hedge that uncertainty to make sure that you're protected, you could buy puts, right? That was the original design of these options and derivatives. And same thing for futures, right? If you trade oil and you're concerned that oil prices could go from 90 to 50, how do you protect your business? Well, you can buy puts, right? And then the question is, well, at what level do you want to secure, right? Do you buy insurance, whether it's your house, how much money do you want to spend, or for what amount do you want to insure your house and for what time frame? Right? It's the same. It's insurance and options, sometimes come synonymously. You can also use options as a speculative play where you think that the stock is going to go higher and you want to leverage your account and express your bullish idea, right? And you can do that too. And also you can do neutral. So any ideas you have about where the underlying asset is going, you can express it in trading options. All right, so let's jump into strike price selection. So in order to trade options, you need to know the terminology, right? So the price of an underlying stock can be purchased or sold at a certain strike price, right? Just like your house, if you live, average house in the United States, $250,000, you need to decide how much money you want to insure, right? Your mortgage company can say, well, you need to insure at least for $200,000 or $220,000. They will send the appraisal. They will try to figure out what the estimated price, and that's the strike price. So strike price selection, you basically saying to what level the stock can go by a certain time frame. So for the calls to go higher, for the puts to go lower, what the underlying stock is. So what has been my approach? Or general approach, we're going to ask AI right after this presentation what the AI thinks. But one is the probability, right? In trading, whether you're trading stock or options, you never have 100% certainty, right? You have certain, going back to your statistics class, right? You basically can say, if I flip or if I roll two dice, right? If I roll two dice, which number is going to come out more often, right? 7, right? And which number will come out least often, right? Let's say, 2 1s, right? Or 2 6s, right? Those happens, beyond one standard deviation, maybe 30% of the time, but 50, 60% of the time, you're going to have 5, 6, and 7. Trading is statistics, right? Trading is statistics. So you do need to have a concept of some kind of a probability calculator. There are a lot of broker dealers will provide you with a probability calculator that you can say. In this example, I took the screenshot when S&P was at 6,800, right? I thought that we could not get to 1,000 level, 7,000 level, but here we are. Market kind of, I think this was one of the biggest rallies of the 10% drawdown I think, in history, if I read it somewhere correctly. When the market pulls back 10%, how quickly it recovered and actually made new record high, probably one of the highest, one of the fastest in history. So I took the screenshot, I think, a few days ago when S&P was at 6,800, and I looked at the probability, and where could the market go. And back then, by this time, the idea was that it's not going to go one standard deviation, right? 70% of the time, it's going to stay at 6,900. And 7,000 had a very large open interest, right? This vertical bar. Let me see if I can draw this. So I'm looking at this bar. This is a positioning, right? So billions of dollars were positioned at 7,000. A lot of hedge funds, a lot of wealth management, they are selling calls, right? This is call. They're selling calls to hedge their portfolio because the idea is that it might not breach the 7,000 level. So you have a concept of probability. You can look at the options data and determine what is the probability the stock can go to 7,000 from 6,800, right, in this example. You can look at the historical data. You can look at, how much does the S&P moves per day on average, right? When VIX is below 20, right? When VIX is below 20, S&P moves less than 1%, right? When VIX is above 20, 30, on average, it moves 2%. So you can look at this range and historical data to determine where the stock can, how far can the stock move, and that would be your strike price selection. Let me see. All right. Now, how do I erase this thing? Here. Give me 1 second. Technical. Share back. Clear. Clear all wrong. Okay, sorry about it. And then go back here. Okay. So then you can use different analytics to determine support and resistance level. In this example, I'm looking at the open interest, right? 7,000, where the stock market can gravitate toward. And you could do traditional technical analysis to look at the support and resistance levels, right? We talked about Bollinger Bands before. We talked about 50-day moving average, 200-day moving average. There's different ways to find the support and resistance level. So when you go through the strike price selection, you do want to look at the time range. So the first step, you have to decide if right now SPX is actually right at the 7,000, a little bit higher, almost gravitating toward 7,100. What is my time range? Am I trying to hedge my portfolio till May? Am I trying to to June or August, right? We're in the middle of the earnings season. From seasonality point of view, usually market continues to go higher. And maybe you want to hedge, but August, September has been very volatile, and we're still in midterm election. So you might want to say, May is not enough. I want to go into September, right? Use leaps or go into January. If you just want to hedge this earnings season that's kind of we just started, you might want to select June or May. So time range selection is very important. Then you want to determine directional bias. Right? Let's say if you're bullish on SPX, right? Maybe you want to buy call or call spreads. In this example, it would be a call spread because you feel, my thought process is that we cleared 7,000 yesterday, right? Today we're about 7,000. If tomorrow go into the weekend and it's we already have some earnings data, and I'm bullish on the earnings, I'm not as concerned on oil prices, then maybe I have a bullish opinion, right? And I want to buy a call spread because I think market is going to continue going higher. By May, I can look at the probability calculator where it can stop, and I'll buy a call spread. If my bias is bearish, oil prices are at 100, and if the oil prices do not drop to 60 by end of May, we might have stagflation or recession, then maybe I want to hedge my portfolio. And if it revisits the recent lows, let's say 6,500, 6,600, right? So I'm buying QQQ put spread or Spider's put spread. So first is the time range selection. You always need to think about time when you figure out the strikes, right? You need to, because the more time you're relying, the further the higher the range that can trade, right? S&P probably not going to be at 7,100 by end of today, but it could be at 7,100 by end of tomorrow, right? Or by end of May, it could be at 7,200, right? Or 7,250. So based on your time range selection and your directional bias, strike price will be influenced by these two directions. Volatility, right? Do you think that volatility is going to increase? Is the VIX going to 20, 25, 30, or is the VIX going to 15, 12, right? Based on the volatility, it also increases the range where the stock market can trade and hence your stock price selection. What is the purpose of selecting those strikes? Again, are you speculating and you think or are you hedging your positions? And you always want to look at the risk versus probability of success, right? When you select these strike prices, you want to look at based on historical volatility, based on implied volatility, what is the probability of stock reaching that level, and how much risk am I taking, and what is the probability, right? Some people like high risk trades, right? When you buy out of the money options, they're higher risk, but they're also high probability of success, right? Fred likes to sell put spreads further out, then his risk is less, but his probability of success is greater. Right, it's very hard to find trade where there's very low risk and very high probability of success, right? Unless you have an edge, unless you have some kind of you're running a hedge funds and you have advantage over other people, then yes, you can have low risk, high probability of success trades. But for average retail investor, you do not. So here's an example of some of the bias analytics in terms of volatility. You can look at implied volatility versus historical volatility to tell you how far the stock can move and hence your strike price selection, right? And you can also look at traditional technical analysis to determine the trend, right? What is the short-term trend for? I did this for SPX. Short-term trend, very strong, right? Historical move, I think now it says maximum. Basically, you're not going to see a lot of time where market is down 10% and then you make a new all-time highs, in 2 weeks later. Medium term is still weak, and long term was still weak a week ago. Now it's getting a bit stronger. Keith, I know I've been talking for nonstop, but any words of wisdom when it comes to volatility and strike price selection and
Yeah, absolutely.
expressing your bias?
One of the big things for me, and you kind of touched on this, is that you can use these options analytics to try to figure out other support and resistance levels, just like you can use the technicals. And I think back to when I first started as a market maker, I didn't have any background in technical trading. I only looked at the options markets, and I knew generally where a stock was going to stop going up because everybody was selling calls to me as a market maker at that strike level. And so I knew that every time we got there, all of us market makers were going to be selling stock to hedge our position. So it's, these technical levels are built upon finding levels where inventory can come to market. So where is the market maker selling? Where is the value-based investor selling? All of these can really help impact that strike point decision. And so if I know these big hedge funds are all selling $7,000 calls, well, when we get there, the market makers are going to be selling stock or futures as well. And so that increases that inventory and reduces the probability that we run to 7,200 in the short term. A lot of this is really key for just trying to combine all of this information and then analyze it and find those strike points that you like as a trader as well.
Thank you. Sure. Quick fingers. Okay, in volatility analysis, trend analysis, technical analysis is important. Then estimated move example, right? I like this chart. Again, I took this maybe a week ago, a little less, when S&P was at 6,800, and then I looked at the expiration, right? So if you want to determine where's the market going by May 15th, right? By May 15th. And again, in volatility decreased, but in market moves, so the range changed. But at that point, by May 15th, the upper range was 7,062, where we currently are. So the momentum behind the stock market has accelerated, right? And it did move the range. So just because a week ago it said one standard deviation, we're going to be by May at 7,062, that does not mean you cannot be there, before, May 15th. We are only in April 16th. We're already at that level, right? So the momentum behind the bulls, definitely accelerated from the 6,800 when I took this screenshot. But the point is that now I can rerun this uh, estimated move analysis and look at the options data by May 15th, and it will tell me now probably it's going to be close to 7,200, right? 7,200, and on the bottom is 6,800, right? So this analysis is very important when you trade earnings, right? When you trade earnings, we had today we traded Taiwan Semiconductor, Pepsi, right? You can see what is the historical move for Taiwan Semiconductor, what is the historical move and implied move for Pepsi. And if you have these stock positions, then you can decide what level you want to hedge, right? Based on implied volatility move and based on historical volatility move. This is implied move, right? This is going into the future. But you can do this analysis. You can use 0 days till expiration. If you trade in 0 days till expiration, you can look at this analysis. Where's the SPX is going to trade tomorrow, right? What is the range? You can look at the historical volatility to determine at what range the stock can move, by tomorrow, by Friday, by May expiration, June expiration, any time frame you can select, you can determine that. So that's something that I do use, especially if you have a stock position and you want to hedge it, right? Or if you don't have a stock position, but you want to set up, sell iron condor or sell credit put spread or credit call spreads. You want to be short volatility, or if you want to be long volatility, right? If you want to buy a call, out of the money call, and take that lower probability of success trade but higher return, what strike is reasonable to select, right? You don't want to select a strike where it requires 2 standard deviation move. I mean, you'll get it right 1 out of 10 times, but 9 out of 10 times you'll be wrong. And now you need to make sure that the 9 times that you were wrong is less than the 1 time that you're right. Keith, do you use estimated move analysis or something similar?
I think it's similar, but a little bit of a different way of running it for me. So oftentimes I'll just look at, for those of you that are familiar with more of a complex option strategy, a straddle. If I look at the SPX April at the money straddle, the one expiring tomorrow, it's currently priced at around, let's see, $49. So that effectively tells me the market is roughly expecting the SPX index to move about $50 between now and the closing bell tomorrow. That's a quick way for me to look at it, just using the options data. Now, that does encapsulate the fact that there is some trading around a long straddle for a market maker, so they do tend to be priced a little higher than the actual realized moves that we get. But when I'm looking for a short, quick picture of how much we might move, that's one thing I like to do. And it also, I think, helps temper expectations because, you might look at a stock and say, I think it's going to go up 10% tomorrow. And the market will tell you if that's likely or not by looking at the strikes and saying, okay, 10% tomorrow, that's not going to happen. Or 10% on earnings, that is actually a low expectation. You're looking for something closer to 20% because this is really volatile on earnings. And you can use those short-term straddles to kind of get a sense of how much volatility there is in the coming days.
Perfect. Thank you. One way to look, a quick approximation, is to look at the delta of the option, right? So here, I'm looking at when S&P was, let me do my magic drawing. Right, so the last price is 68.24, right? This was a few days ago. And then, I know there was a high open interest at 7,000. So I wanted to know that if I buy the 7,000, in this case, call, right, how much do I have to pay? right? $55.70. What is the open interest at that strike? You can see very large open interest. I want to see liquidity of this trade, right? And what is the delta, right? What is the delta of this trade? So you look at the probability, right? And you look at the delta. So those are the two, if at that time, if the delta is 30, right? Let me see, just give me 1 second. Yeah.
Vlad, can you explain what delta is, just in case anyone here is new to this?
For sure. So yeah, so delta, that's a good question. I like that. A good point. So delta is basically for $1 move in underlying stock, right? How much is the options going to move, right? So 21 delta of 21 cents, right? 0.21 means that if SPX moves if underlying stock, or in this case, SPX moves by $1, how much is your option going to move? In this case, 21 cents. If delta 50, then by 50 cents, and if delta is 1, then 1-to-1 correlation. It just gives you correlation of move of option versus stock, but it also gives you probability. If the delta is 21, usually it's a quick approximation that by this date, there is only 21% chance that we could get to the 7,000 level, right? Sorry, 7,000 level here. So that is what the delta. It's a Greek, right? It's a derivative. It's the one of the Greeks for option derivatives to show you what is the probability of stock reaching that level, right? And usually staying at that level, reaching that level is twice than staying at that level. Something also to keep in mind that by May 15th, reaching and staying at that level is a lot smaller probability than reaching that level and staying at that level, right? Keith, what do you any words of wisdom on delta and probability of profit?
Yeah, absolutely. One thing just to note, hope everybody bought those calls a week ago because those are over $150 now. But all kidding aside, one of the things that I also like to take into account on these sort of things is not just factoring in the probability of profit, but what that really means in terms of how much profit I need to achieve to make this a positive expected value trade. So if the case is 20% probability of profit and 80% probability that my option expires worthless, then that tells me how big my winner has to be relative to my loser. 80% of the time, I'm going to lose it all. That means 20% of the time, I need to make 4x my initial investment. So once you start to picture those scenarios, if you think there's something that has a 20% chance of doubling, you start to realize that that may not actually be a good trade anymore. And so factoring in the magnitude of the gain I need to make is, I think, crucial as people start to reevaluate those out of the money options.
Thank you. All right, so just to summarize, use delta or probability calculator. Delta serves as a quick proxy for approximate probability of your stock reaching certain level by certain time. Do look at the volatility. You do have to have an opinion whether the uncertainty in the market is going to increase due to geopolitical risk, or is this all in rear view mirror and AI is here and Microsoft and Google are going to beat the earnings estimates and volatility is going to decrease, right? So you do have to have that opinion. Account for liquidity and transactional cost, right? When we trade options, yesterday was a perfect example where I was looking at the regional banks to do the earnings versus Taiwan Semiconductor. And you can see for Pepsi, for Taiwan Semiconductor, the levels that where the stock could end up had thousands of contracts, right? I think Pepsi at 160 had 17,000 contracts, right? You can see Pepsi reached 160 level, 160 strike, right? And got rejected. I think now it's probably 158 or somewhere, or at least before. So these levels where you have very high open interest and you have a lot of liquidity, and the market maker has to support these levels, work as a very good way to determine support and resistance level, and will they be reached as a magnet or will they be as a magnet or repellent? Same thing with SPX. Is SPX is going to be a 7,000 where it's just going to be glued at least until April expiration on Friday at 7,000, or can it reach an escape velocity and move beyond 7,000? Match to expected price move and break even using technical analysis, expected move calculations to determine that range. All right, and then AI. Actually, I did it a little bit late. Oh, I did a little bit late, but I asked Winston, how do you select a strike price? And it was great. So you can do this analysis. So when I went to option trading, right, and live trading yesterday, we were talking about Pepsi. I know some of you are on this broadcast, so we did this trade. So 160 strike, right? The 160 strike had a very high open interest, right? And Pepsi got exactly to almost to the penny, right? To the 160 strike, right? And then it got rejected a couple times. I mean, it was 158, I think 157, but it's still acting as a magnet. So now we're at 159. So looking at the open interest and looking at the volume can help you determine what that support and resistance levels are. And the stock open, there's no open price here, but it opened somewhere 158, 157, right? So this is a great way to determine what is the probability of Pepsi reaching 160 from yesterday to today and staying there, right? And then I can go in and clear all my drawings and go to research AI, right? The proprietary AI kind of been actually trained on the options data and train on broker dealer information to make sure it doesn't hallucinate and give you the right answers. You can say what strike price I should select for. Well, let's do Pepsi. Let's see. Give it a second. I did get logged out, so I prepared the slide, not the slide, but I wanted to do a real-time presentation. And we'll see what it says.
Thanks, Vlad. I'll just remind folks if they have questions too on your presentation so far, they can put those in the chat or the Q&A while we're waiting for the AI to answer your query here.
Okay, so the question is all about your market outlook, right? We talked about market outlook, right? Your bias, bullish or bearish, risk comfort, how much risk you're willing to take, and what you want from the trade. Let's break it down approach, right? So strike 155 in the money call, delta 80, right? Medium price, mid price is 460, and then you can see 160 call, and this could be delayed data, so because the market did move. Delta 45, right? So it means if the stock moves by $1, it will move by 40 cents, right? Delta is the guide. Lower strikes have higher deltas, meaning they behave more like stock, right? So when you're not very speculative, right, you spend more money on the in-the-money options, but your probability of success is high, right? So high delta, more expensive, right? Bottom line. But you have less extrinsic value, right? And higher probability of success. So less leverage, but higher probability of finishing in the money. Lower delta, cheaper, more leverage, but greater risk for expiring worthless. So that is a very important guidelines. And I encourage you to use the AI to kind of remind you when you select strike prices for your options, or even if you trade stock, right? If you trade stock and you think Pepsi can drop or reach 165 level or drop by, instead of going up $4, it could have dropped by $4. Does it make sense for you to hedge 150 strike or 145 strike? We talked about liquidity, right? Open interest is highest around 155, 160. We saw 160 strike as the highest, suggesting that these are the most actively traded options. Tight bid and ask spread, and dealers will support the trade, right? As the stock is gravitating toward 160. What matters, more liquidity can mean either entry, exit, and potentially better pricing, right? Very important. If certain regional banks yesterday decided not to do it because the bid and ask spread was wide and there was no positioning, right? People were not trading. And then, it goes back to the game theory, right? You want to know what other people think and what other people do. And if you cannot see it in the positioning data, then it's harder to trade. Choosing strike price is about balancing cost, probability of profit, and your market thesis. Closer to the current price means higher chance, but higher cost. Further out means lower cost. Direct exposure. And then it shows you correlation with the underlying ETF, right, and peer sentiment, like Coke. Okay. Keith, any words of wisdom on AI or how to use it?
Yeah, no, I mean, I think actually they gave a much more complete response than even I was expecting out of it, and I'm really impressed with the way that Winston kicks out the answers there. And then a little bit more note on like Pepsi for earnings, just as I was thinking about it here. One of the keys with the market maker, the options market maker, and why those big open interests become a big magnet. If I'm the market maker, my general job is to stay delta neutral. That means that every time I've got a 40 delta option, I sell 40 shares of stock. When we're dealing with that 160 strike in Pepsi, if we start to fall below 160 and I'm long those calls, my delta is decreasing. So I'm a buyer of stock every time it falls, and every time it rallies back towards 160, I'm a seller of stock. When you've got 18,000 open interest, that could mean millions of shares transacting, trying to buy stock on falls and sell stock on rallies. When Pepsi trades, 5, 10 million shares a day, but if the options market maker is constantly hedging every time we get a little bit away from 160, just below or just above, it helps force that magnet there. So, just kind of reiterating some of what we were already talking about, but thinking about why that magnet really exists from an option market maker perspective, who does not have an opinion on how bullish or bearish Pepsi's earnings are. They're just trying to manage the risk that they've got from owning these options.
Thank you. No, this is great. That concludes, sorry, it took a little longer. It concludes our presentation. This is the contact information for Keith and I, vlad@yellowtunnel.com, keith@yellowtunnel.com. And if you guys have any questions, please type them in, and I'll be more than happy to answer them, and I'll turn the mic to Natalie.
Great. Thank you so much, Vlad. And thanks, Keith, for all the input on there. I'll have you leave the slide up just for another minute in case people need to write down your contact information. If you have specific follow-up questions for Vlad or Keith regarding this presentation specifically, definitely reach out to them and get some follow-up information. I had received a couple of different questions during your presentation. Just to address a couple of those that came in that were the same. Yes, we are recording this afternoon's presentation, and everyone will get a link with the recorded replay that's going to be sent to your email inboxes from info@tradeagt.com. Just to call out Bill, I don't know what Vlad's going to send for a free gift, but his shirt size is large, Vlad. So if it's a free T-shirt, there you go. Yeah. So yes, if anyone does have any last minute questions, please feel free to type them into the chat and we'll squeeze them in here. Otherwise, you can send those questions over to Vlad at your convenience and he'll reply accordingly. Just one final reminder as we wrap up today. If you're not familiar with our website, please go to the Avant-Garde site, tradeagt.com. We'll get you there, short and sweet. You can go into your own brokerage account, sign up, get an account, and start your trading. Start selecting those strike prices that you learned about today. And if you are one of the individuals who use third-party trading programs, you can also have those traded for you by the team over at Avant-Garde using our program trading model with letter of direction. So please feel free to reach out to the team to get more information on that. You can reach us at info@tradeagt.com or via phone, 312-858-5748. So please do that. And as a reminder, always sign up for our educational webinars. Thank you again for joining us. Vlad, Keith, thank you for taking the time, putting together the presentation and answering questions and really engaging the audience. And thank you to those of you who joined us live today for participating and answering Vlad's questions, sending us little notes and shout outs. We do appreciate it. And I hope to see you all at the next free Avant-Garde webinar coming up next week. Feel free to register, and we'll definitely have Vlad and Keith back as well. So keep an eye out on your inboxes and be sure to sign up. Thank you so much.
Thank you very
Vlad.
much.
Thanks, Keith.
Thank you. Thank you.
Yeah,
Thanks,
you.
everyone.